Good morning, Jags. This is Fahad. Today is Wednesday, June 24th. Okay, let's get started. How's everyone doing?
Doing pretty
Good.
good yourself?
Doing well.
Good, good. Um, so I'm going to be searching for a bit of bearish trades this morning. Want to have a bit more exposure to the downside if we start to see some short-term weakness. So I'm going to be on the hunt to make some bearish plays and want to increase a little bit exposure on the short side further today, tomorrow, in the next couple of days. I think that overall, this is morely from a reasoning of a cautiously optimistic view, but I think that we're seeing some signs in market internals that are just simply worth watching. So, for example, as I shared in Telegram just earlier today, if you look at the NYSI Summation index, that is now giving us a bear cross after a long time. First one actually since middle of May, and the last one that we had in the middle of May resulted in at least minimum of a consolidation pattern in the S&P that lasted for several weeks. So we now have that NYSE Summation bear cross again, but the difference this time versus last time is that we are so significantly overbought that we potentially may have this to go all the way down to possibly 200 or even zero line this time in this NYMO summation. So if that happens, we could be in another retest of 3,000 in the S&P, and if we lose a 3,000 level, we could be down to 286 level in the SPY or 2860 level, which is a level that I pointed out multiple times where the gap that remains to be filled. Similarly, we have seen a lot of other readings are starting to come off the highs. And so you can see the percentage of the stocks above the 50-day moving average, they're starting to roll over. Same thing with the percentage of stocks above the 50-day in the S&P 500 index, they're starting to roll over. It's the trend that's more important than anything else. So just overall, the reading indicators, a bunch of indicators on my list continue to be a bit of a corrective mode that's starting to appear. Now, with that said, I'm expecting a big sell-off in all the cruise ships this morning. And so here is Carnival Cruise. It recovered yesterday. It was down quite a bit yesterday, but then it recovered, closed at 18, and now it's trading below 17. So this thing is going to gap down 6-7% in pre-market. Royal Caribbean is also gapping down by 4-5%. And NCLH is also gapping down, but it's not going to be just this. There's going to be some pressure on a lot of other names that continue to remain very sensitive to the opening or not opening, those kind of groups. So that's what I'm watching. See if I can push some bearish bets on those. IBM caught my attention yesterday, where we started to see some pickup in put option activity. So this is a stock that's now on a cusp of a potential breakdown. The volume was pretty high yesterday as it was attacking a trend support. And so similarly, last 2 weeks ago on Thursday, there was a big sell-off in the market, high volume sell-off in IBM, but it bounced off the trend support and now it's trying again also on high volume. So I think this is vulnerable here. And if it loses this VOP support around 119, 118, 119, I think this could head back all the way down to 107 to 110 range. So we're talking 6-7% sell-off in IBM. So that's one to watch. So, similarly going to be looking at the same kind of sectors. And lastly, I want to just quickly touch upon, also briefly discuss this in Telegram last night, but Open Table reservation data shows it does a pretty good job of reporting on a daily basis the data on the restaurant reservation systems across the whole country and actually across the whole world. So it may not be the perfect mix, but it gives us a pretty good glimpse. I don't know if this is telling us a story that is new, that is emerging, or this was just a one-day anomaly, because we discussed yesterday in webinars a spike in COVID-19 cases. So I just wanted to show that this could translate into a lot of weakness in restaurants, such as one of our favorite shorts we have discussed is Cheesecake Factory, symbol cake, CAKE. That could be on the weakness. Again, we could see that that's very much attached to malls as well. So there could be pressure on the malls, departmental stores such as Dillard's, DDS, which we have shorted multiple times, Kohl's and such. These are all consumer stocks. If you go down to the list here now, this will be updated sometime later today for yesterday's data. Yesterday was June 23rd. It's not reflected in this spreadsheet yet, but it will be updated. But if you watch carefully, and if I go by city, take a look at this, what's happening. So a lot of the U.S. cities, but some international cities here as well. These trends have suddenly started to become worse again, really starting from Sunday, or actually really started from Monday. Maybe it was because we saw a big spike to 30,000 cases in the US on Thursday, and then Friday was another 30,000 reading. Saturday was 30,000 plus reading. Sunday was a little bit lower, and then Monday was up. Yesterday, we saw a 35,000 reading in the in the COVID-19 cases. So maybe people are watching this and saying, you know what, I don't need to go out to restaurant here. But if you watch carefully any of these trends, so take a look at Chicago, for example, 89.1% down year over year on June 22nd, basically after a trend that was starting to improve. You can just Fort Lauderdale, you can see over here, this was starting to gradually turn flattish, and then suddenly big down. You just go to Houston, take a look at Houston. Houston for a long time, for the last 2 weeks was about 40-50% down, and slowly improving, and then suddenly 71% down. Las Vegas sends the same way. So I don't know, June 22nd feels like that there was across the country in almost every city, there was a significant decline sequentially in the total reservation system. It was not a holiday. It was not something unusual about it. Here's Scottsdale, Arizona. So we know that the cases are going up in Arizona as well. San Diego, you can really look at any of them data. All cities are showing exactly the same thing. Or you can look at by states. So something to keep in mind. If this becomes a new norm and when more columns are added here for June 23rd and beyond and continues to be worse, then I would expect we're going to see pressure on names like Cheesecake Factory. Possibly will return back to March lows, and we're going to see pressure on blooming brands. Possibly could return back under $10 per share. We actually saw a little bit pickup in put option activity in this stock as well, and all these restaurants that are connected to the departmental stores as well. And then also the real estate sector then also gets into play, such as CBRE. And some of the other ones that we have talked about. So be mindful of what's going on and how people are reacting to all this data. So just a high level view. I'm going to be hunting for some shorts, and then we'll go from there. Avo?
Morning, everyone. On my watch list, or what I spotted yesterday, was IOVANCE. IOVA is the ticker. I spotted call buying in September. Let me just get the strike. I think it was a 35 strike. Yes, September 35. 3,100 calls were bought, added to that open interest that was there before. And looking through, they presented some data at the end of May at the ASCO teleconference this year regarding a cancer treatment. And further down this year, there should be some more data coming out in the second half of 2020, and then they have a bunch of data coming out second half and also the fourth quarter predominantly. But so this is possibly what this trader is targeting. The data that came out was an update on the fourth cohort of this trial, which I try to look, I don't see a name or anything. In any case, 68 patients were treated with a lifileucel cancer treatment, and the overall response rate was 32.4%. Now, typically in other studies, we do see response rates of up to in the 60% range, but considering that the expected overall response rate is usually in the 10% rate, this was pretty impressive to say the least. So that's what I see today, and this is more of a second half 2020, probably a third quarter 2020 play. Now, after September, the only options are available is December, so I'm assuming that this is why they didn't go out to December. Perhaps they're
So
expecting something soon.
it looks like 5,000 of these September 35
Mhm.
calls were bought to open yesterday. They paid up to $3.40 offer. So this would amount to about $1.6 million in bullish bet, and the open interest shot up this morning, so it's clearly reflected in those September 35 calls. Avoid, this might make a good article for homepage.
Yeah, it's just the only time we mentioned this, Jay had mentioned when there was some chatter that it might get bought out, but in the end, the company did at the end of May, where you see that drop, they did a large secondary offering, $500 million or something like that. I may be wrong, but there was a large offering. So typically when the company does offerings like that, they're not getting ready to be bought out. I will definitely take a look further into this. It looks pretty interesting.
Yeah, discuss the pipeline, particularly this catalyst in the third quarter, considering the positioning was also in September, if we're going to do an article on this one on homepage. All right, good stuff. Jay.
Hey, Fahad. So yesterday I talked about CBOE. Today I want to talk about CME Group, ticker is CME. JP Morgan has a note this morning talking about how CME's open interest is under meaningful pressure. They talk about how open interest has fallen to new lows of 102 million contracts, and they see declines across multiple asset classes. The pressure is greatest in their rates complex, with open interest down 34%. However, other classes such as agriculture, which is down 17%, Forex is down 15%, metals is down 6%. So all the open interest is continuing to be under pressure. In addition, the number of participants trading these futures contracts, that has also been declining week over week. Euro FX is down 6%, WTI crude down 2%. So therefore, all of this falling open interest, according to JP Morgan, is rather unusual for CME. Looking back, there were two notable times within the last decade that this happened. You saw open interest decline, which then led to volume decline, which then led to stock decline. The most notable being in 2012, where open interest fell 11%, then volumes fell 15%, and then the stock price underperformed the S&P 500 by 850 basis points, and then underperformed the XLF, which is the financial ETF, by 2,500 basis points. So keep an eye on this stock.
Interesting. If we, the worst case scenario potentially for, I would imagine from a high level standpoint for these exchanges is that we go into what Avo discussed in a Q3 call also, basically a period of consolidation potentially in the equity market for a couple months during the summer while the volatility continues to get depressed. And with that, the volumes across the board in all asset classes also continue to get depressed. This would be the most frustrating kind of pain trade if we were to have during the summer, where neither the bulls or the bears basically were to work out, and we go into this ever declining lighter and lighter volume tight consolidation essentially in the market. If that happens, that would be naturally very, very bearish for CME, because, and maybe that's what all these declining open interest is reflecting as well. Something just keep an eye out. I think that there's just too many high level catalysts that are out there that I think only time will tell whether the volatility will decline and remain suppressed for too long. The stimulus packages, the interest rate swaps, the trading there, as well as the the forex market continues to be quite volatile if you look at US dollar and even the equity markets. But we'll see. Interesting thoughts over there. Well, on a technical basis, if this thing breaks through $170 per share, there might be a small quick trade over there using some short-term put options. Interesting. That was it?
Yep, that was it.
Chronicle.
Morning. So this is to do with work from home trends. Citi was out with a report this week talking about remote work. Specifically, they found that out of 483 occupations that were observed, 113 of these jobs can be performed remotely. More importantly, these 113 occupations make up 52% of the US workforce. Nothing surprising there. But what caught my attention was that the report goes on to forecast a 25% reduction in corporate travel going forward versus 2019 levels, and also a 1% reduction in corporate travel volumes, which implies a 10% impact on airline revenues. And they're saying this is not temporary, but rather more permanent. So everybody knows by now all the near-term headwinds facing airlines. For example, this chart of TSA passenger checkpoint traffic shows air travel has remained pretty pathetic in June. But I don't know if less future corporate travel due to working from home has been baked into, say, 2021 numbers and beyond. So we have short-term headwinds and longer-term secular headwinds. I remember saying several weeks ago on here that to buy airline stocks for a nimble trade rather than the plane makers, and buying trash like Nordstrom for a trade as well. And while they have worked out with those stocks ramping 20 to 30% in a space of a couple of weeks, I think those types of trades are over now, and I wouldn't be getting married to them. On a similar note, we had UBS yesterday saying as many as 1/3 of their employees could work remotely on a permanent basis. So UBS has 70,000 employees in 50 countries, including about 6,000 in North America. I keep seeing headlines like this every week, which I've talked about when I covered Bank OZK, which I'm still short. But what I wanted to talk about this morning is Steelcase. The symbol for that company is SCS. This is not a short yet because the stock has been in a rising trend due to higher backlogs in the near term as a result of manufacturing closures. But I think it's going to be a short at some point. What this company does is it makes office furniture. And this is a highly competitive yet slow growing industry. Like even prior to COVID-19 and the rise in work from home, the office furniture industry was projected to only have 5% CAGR through 2024. And Steelcase's main competitors include names we've probably heard of like Herman Miller, Urban Office, and Knoll. But what makes it worse for Steelcase is that it has a lot of exposure to tech companies and startups. And as a result, they cater to a highly niche market of modern open and shared workspaces, which are now at risk due to how telecommutable tech and software engineering jobs are, like the sort of workspaces shown in these pictures I've shared. So judging by work from home trends, as well as an uncertain environment with a pandemic, and also we don't know what the political landscape is going to look like in January. Plus, the SBA won't be issuing any more PPP loans after this month. I believe a lot of discretionary CapEx is going to suffer. So even if we assume the unrealistic scenario where we all go back to offices to work and businesses don't downsize their office space, even under that scenario, I don't know if companies are going to want to invest in new furniture at a time like this. I would imagine anyone suggesting to their bosses to buy new chairs or tables for the office right now would probably get yelled at. So based on the price action, SCS is not a short right now, but it will be at some point when that rising trend line breaks.
Yeah, very interesting out of the box thinking, and along with the same theme that's related to the office, is why we continue to circle with a bearish view around Iron Mountain for the same reason, IRM, because the company provides, the shredding business into office buildings, and naturally, a lot of the work from home crowd has basically shredded that piece of business. So, anyways, talking about your travel, did you guys see this news on New York Times yesterday? It came out late last night, and every media was talking about this, that European Union officials are considering reopening borders, but while at the same time barring American travelers from coming in, according to New York Times. And so this is because, again, what I just showed the chart in the webinar yesterday, comparing the total number of COVID-19 cases on a daily basis in the entire European Union, which has 300 million people, versus the entire United States, which also has a little over 300 million people. And you look at the charts and you go, such a huge disconnect. And so that could be coming down the pipe. And so going back to the TSA checkpoint throughput, whatever the pickup you're seeing in traffic, there was always going to be some pickup. I mean, we're never going to be down 90-95% and stay there forever, but we're still down from 2.5 million to about half a million right now. So on a percentage basis, we're still down 80% from normal traffic trend. But if you expect that number to come all the way back, it's going to be a very, very long, a very slow journey. And if potential shutdowns happen again, like Houston is considering right now, Texas, the governor of Texas was talking about it yesterday as well, then it's going to be very, very slow recovery. We could be in a year from now and it still only be halfway through, or maybe not even that, in terms of TSA checkpoint throughput, something to keep in mind. All right, good stuff. Let's stop here, and I'm going to be looking forward to whatever you put together on SCS Chronicle. Will be interesting to watch. That's it from us, and we'll see you in the chat room shortly.